Visa has just reported their second quarter results for 2024. What we're going to be doing is looking at these today and seeing why the market has reacted very favorably. It is up 2.5% in the pre-market to $281.37 a share. What we're going to be doing is talking about the earnings, then taking it to my automated stock valuation spreadsheet to see if Visa is a buy or a sell using this discounted free cash flow model, the comparable company model, and finally the Ben Graham formula for intrinsic value. So let's have a look at these earnings. We'll be going in a little bit deeper, but Visa reports fiscal earnings for second quarter 2024. GAAP net income is $4.7 billion or $2.29 a share. Net revenue $8.8 billion, which is a 10% increase. Growth in payments volumes, processed transactions, cross-border volume payments have been stable, and a share repurchase and dividend of $3.8 billion. You can see here the numbers on the income statement. Net revenue up 10%, GAAP net income 10%, GAAP earnings per share up 12%, non-GAAP and non-GAAP earnings per share up 17 and 20%. Key business drivers, payments volume, as I said, these are up 8%. Cross-border volume, excluding intra-unit, 16%. Cross-border volume total, up 16%. And processed transactions, 17%. So we'll skip through this and just have a little look at some of these numbers right here. Sorry if I just scroll down a little bit more. We have the net revenue here. These are the 3 months ended. You can see that the current net revenue is around about 8.7 billion. Let me just scroll up actually and look at here. This is broken down between revenue, which is the service revenue, data processing revenue, international transaction revenue, and other revenue. And if we look at these year-over-year changes, other revenue is up 37%, but that is the smallest part. Revenue up 7% to 4 billion. Service revenue up 12% to 4.2. So what we'll do here actually is we'll look at my automated stock valuation spreadsheet. If we put in ticker V, this will load all the company's financials. But one thing that a lot of things don't do, and this is true on Yahoo Finance, these numbers are not yet in they haven't been sort of formatted and put in there. So what we can do here is if I put the numbers in here and put in Visa's revenue, which was 7.8 billion. You'll see that that number updates, so we can get the most up-to-date numbers. Net income, as I said before, that is 5,117. Cash operations and free cash flow. If we quickly go back to here, unfortunately, what Visa did, which is slightly annoying, but anyway, what you're going to do is they have the cash flow statement here. This is the last 6 months. So if I just go back to my sheet and scroll a little bit here, I have put down the numbers that are the prior quarter to that, so I can just minus them off each other, and then we'll get the numbers here. So I'll just do this on my other screen quickly. If we go to the, I can't find it because I'm looking on a smaller screen. Let me quickly go. Operating income, where is it gone? There we go. So the last 6 months, the net cash in operating activities is 1,852. So then if we minus this number here, oops a daisy, should learn how to do sheets better, minus that, and then the cash and cash equivalents was 548. And then if we do minus that one as well, minus this number, we will get the actual free cash flow for the trailing 3 months, which is around about 4.3 billion. Just to show you where I got that from, if I look at here, we have, this is the 6 months ended, net cash, and then cash cap expenditure. So we take away the prior months. So this will actually give us the values using the most recent trailing 12 months. If we go to revenue, once again, revenue is up, all-time highs, 33.5 billion. Net income, similar story again, 18.8. Free cash flow, just higher than their previous number, 20 billion. I mean, look at those margins on the company. If I just quickly go to here, profit margin of 56%, and they're still growing. But let's have a look at the discounted free cash flow model. What this is a way of valuing stocks using estimating their future free cash flows. And based on these, we have currently the averages. It's currently a $220 stock. And let's see if we agree with these numbers. Firstly, we'll look at the revenue growth rate. Obviously, it's down because of that. What are analysts expecting in terms of revenue growth rate? They are kind of expecting the number to be at the end. So we'll look at the average estimates: 36 billion and around about 40 billion. Let's see how close we are to that. Yeah, I'd say maybe let's just bring it up a little bit to we'll go 10%. That would put it at a $233 stock. Net income margins, it looks like their net income margins have been steadily increasing. So let's put this to 58. That's a $260 stock. And finally, net income to free cash flow. I would say 2022 is a bit of a blip on that one. Averages bring it about 95%. So discounted free cash flow says it's about, well, slightly overvalued, if anything, $226 a share. Next, we'll have a look at the comparable company model. What this is a way of valuing companies looking at their competitors, and we're looking at certain metrics here. The metrics that I have is well, sort of the comparisons. We'll look at revenue growth rate, EBITDA, profit margin, price to sales, price to book, PEG, which is price to earnings growth, that is popularized by Peter Lynch, EV to revenue, EV to EBITDA, and PE. So what we'll do here is we'll just go a strict comparison, and just to show you that this sheet is all cool and it all works, if I then type in MA, this will bring up MasterCard and it will load MasterCard's details. I would say they are their strongest and sort of equal competitor. And this will load all those values up. Let me just bring that in a bit because it seems we have lost a bit of the sheet there. There you go. So revenue 32 compared to 25 billion. Revenue growth rate, MasterCard actually slightly over 11% compared to 9. EBITDA 23 to 15. Net income, this is where Visa does win here. Profit margins 55%. Revenue is 32 billion. They make 18 billion off that compared to Visa's 25 and 11. So they are more profitable than MasterCard. Price to sales, this is the stock price compared to the revenue, 17 versus 17.3, so very, very close. Price to book, which is the price versus the total assets minus liabilities. And once again, price to book, Visa is lower, 14 compared to 62. PEG, this is the price to earnings growth. What we want here is closer to 1. 1 is fairly valued, under 1 is that. Under 1 is undervalued, sorry, and over 1 is overvalued. They're both quite similar, but actually, according to PEG, Visa is slightly overvalued compared to MasterCard. EV to revenue, EB to EBITDA, and PE. What we want to look for is lower ratios here, and that is why you can see there's a buy compared to MasterCard here, because EV to revenue 17.1 compared to 17.6, EV to EBITDA 24 compared to 29.4, and PE ratio 31.5 compared to 39. Now, actually, as well, if we just look at the PE ratio of the S&P 500 at the minute, 27.25. So out of all the companies, these are slightly higher PE ratio, but sorry, wrong sheet here. But this gives us sort of a calculated stock price of anywhere between 280 and 345, which gives an average of 315. So it is a buy according to that. And finally, the Ben Graham model. This is a way of valuing stocks using Ben Graham's formula, which obviously, as everyone knows, is the grandfather of value investing. It looks at earnings per share, PE of a nose growth company, AAA bond yields, and corporate bond yields. And currently, what are analysts expecting Visa's growth to be over the next 5 years? The next 5 years around both 13.2, and the past 5 years was 14.5. And they're expecting pretty quick growth in the next quarter and year, but let's have a look and see what that does. Around about 14%, $160 a share. So not a buy according to that. They would have to grow over the next 5 years at around about, or even higher than that, 31% for it to be 32% for it to be fairly valued. So Peter Grinch, God, I'm a bit unwell, which is probably why I'm saying the wrong things. Peter Lynch, Peter Griffin, Ben Graham, all there. But Ben Graham would say it was not a buy. But if we look at the comparable companies model, comparing directly to MasterCard, it does look like it is undervalued. Right, guys, thanks for watching. Please check out my Patreon. Links are in the description. And apologies, I am a little bit unwell. So hopefully I will get better and be able to make more videos. Right, guys, thanks for watching, and I'll catch you later.